Hey, it's Paul, and thank you for joining me. Today, Dylan and I are down here in Old San Juan filming a quick market update for the month of December, and I thought, this is a good opportunity to do a breakdown. We get a lot of questions into Potomac, and been traveling, haven't been on the buzz much lately, so I thought this is a good opportunity to enjoy a cigar and talk about some of the questions. Now, I'm not going to read them, but I went through them this morning, and I got a pretty good idea as to who's asking what. So, a question that comes in often is, Paul, I am growing my pest control business. Am I better off focusing on cash flow or growth rates, right? Am I better off growing my revenue at a rapid rate or just focusing on higher levels of cash flow? And, it really comes down to what it is you're looking to do with your business. If a sale is on a horizon, depending upon the financial conditions, I might answer that question in two opposite directions. And here's what I mean by that. As interest rates go up, and financial conditions get tighter, there's a greater focus on the immediacy of cash flow. So we talk about this as almost duration risk. If you pull up on Google Finance and you look at how sectors are performing as financial conditions have gotten tighter over the last year, the sectors that have led the nosedive have really been tech, right? And we call tech stocks long duration stocks because they're not generating a ton of cash flow now, but they're growth stocks and people invest in them because they've got high growth rates and we expect to have significant cash flow at some point off in the future. So we call those long duration stocks. And when financial conditions are loose and interest rates are suppressed and low, the capital markets tends to pull financial returns from the future into the present. So companies that grow at very high rates tend to be overvalued relative to their peers. That happens in resi services as well, with HVAC businesses and pest control businesses. So we've seen a focus in recent years, as interest rates have been suppressed, on growth rates, more so than absolute percentages of profitability. As interest rates go up, the reverse happens. We are now taking the financial returns that we've pulled into the present and we're pushing them back out into the future. So there's more of a focus on the immediacy of cash flow hitting the P&L today. So if you're thinking about a sale, the best thing that you could probably do for yourself is slow down the top line growth rates, focus more and more on the immediacy of cash flow and increase the level of profitability in your business. I think whether it's lawn care or pest control or garage doors or solar or any of these businesses that use door-to-door, door-to-door for me, at least internally, is always a great bellwether or a reference point for duration with regard to these residential service financial assets. And what I mean by that is door-to-door by its very nature, you're spending a lot of money today, right? You're paying sales guys to go out, knock on doors. You're putting on unprofitable revenue, which is effectively what you do when you're doing door-to-door, because you're saying, hey, I'm gonna put on these accounts, I'm gonna have higher attrition rates, I gotta pay big commissions, but at the end of the day, a year or 2, 3 years from now, I hope to retain a good chunk of those. They'll be very dense and they'll be kicking off cash flow. Over the course of the last, 13 years, during quantitative easing and the suppression of interest rates, we've seen door-to-door businesses get higher and higher valuations. And that was extremely acute during the COVID period of 2020 and 2021, when real yields, so real interest rates, were extremely negative and nominal interest rates were, 25 basis points. That has kicked into reverse at a dramatic clip here in 2022. So in my mind, a lot of these door-to-door businesses that are effectively long duration stocks tend to act in a lot of ways like technology companies do. The price increases dramatically when interest rates are suppressed, and when the reverse happens, we start to see those valuations fall off very, very quickly. I think as we get into Q1 and Q2 of 2023, we'll be able to see those duration impacts on resi services businesses. So I guess when you're thinking about it, you want to focus in these sorts of environments on cash flow as opposed to the growth rate and free cash flow. As interest rates go down, you can focus more on growth rates, be a little bit less concerned about cash flow. In a pest control company, what sort of financial metrics should I be looking for as an owner? Over the last 10 to 12 years, we've had a sloping upward line, and more acutely in recent years, valuations have gone like this. Now we're going to see the reverse of that. And so when you start to think about metrics in your own business, you want to have portfolio or recurring revenue. And so you want to sometimes trade off the bigger one-time items for longer-term recurring revenue. And you know, in a perfect world, you're at 80% plus recurring, right? If you look at your business and you say 80% of my business is an ongoing revenue, where I'm billing monthly, I'm billing quarterly, what have you, but it's a ongoing service at a regularly scheduled frequency. When I think about cash flow margins, you know, I tend to use EBITDA, so earnings before interest, taxes, and amortization. When we go out to the market, we always use EBITDA, which includes depreciation. And why we do that is because I think in this industry and most resi services businesses, depreciation is a very good approximation for capital expenditures. So if we look at pure play EBITDA on an adjusted basis, meaning you've normalized your economic benefit to the business, you know, you might be paying yourself a salary of $250 a year, and if you're really only doing $50,000 worth of work, you've normalized that. You've added back your discretionary items, and you ultimately want to be at least 20%. That's, in a perfect world, you're north of 20%. The closer you can get to 25%, the better off you'll be. And of course, there's an interplay between profitability and growth rate. The higher the growth rate, typically, the lower the margins because you're reinvesting back into the business. But from a cash flow perspective, you want to really target that 25% if you can do that. When I think about growth rates, I've always said you really want to try to be at double the rate of real GDP. Right now, you know, real GDP is going into the negative territory. But if you look at some of the larger players right now, in 2022, the majority of the growth is coming from price increases, right? I would say 2/3 of growth this year is price increases as opposed to actual real growth of adding on new customers and retaining old ones. A sweet spot for a resi service business is really in the high single digits to low double digits. You know, if you can focus on 10% growth per annum, you're going to be ahead of the extreme majority of your competitors, and you're also going to be ahead of the publicly traded guys. It's hard to do, and it's hard to do at scale the larger you get. You know, in a $500,000 business, it's pretty easy to add on $500,000 or $600,000 in revenue. You run a $25 million business, that gets more and more difficult. But your target should be 10%, and you should really be in the high single digits if you can swing it. In pest control, you know, we tend to see gross margins in the low 50s, all the way up to 65%, give or take. When I look at gross margins, to me, it tells me a lot about your pricing and your efficiency out in the field. If you've got low gross margins, I might say, well, are your technicians driving all over the place? If you have low gross margins, I might say, well, wait a second, are you not priced at least at the median of the market? Try to get your gross margin as close to 60 as you possibly can. And if you can do that, it means that you're probably routing things correctly, you're not in too wide of a geography, and you're probably doing well on pricing. Let's go back to the pricing discussion because I think it's an important one. And, you know, we've talked about it on the Buzz quite a bit. I've had a lot of conversations over the last 3 weeks since I've been back with clients, and I have continued to say now in December is a great time to audit your customer base and think about your spring price increases. You're going to have to do that again. I mean, we have core CPI running super hot still. I think we live in a world where, you know, I don't know that inflation is going to be 7 or 8% for that much longer because it has peaked. But it's very likely we might see inflation at 4 to 5% over the next 5 years. That is a distinct possibility. So you need to make sure, you know, a lot of you go years without raising prices. So do your studies now. benchmark what the bigger players, not the small guys, but look at what Orkin and Terminix are doing in your market. Look what Rentokil brands are doing in your market. Try to understand where the big guys are. Get as close to them as you possibly can. And if you can pull it off and you've got pricing pressure, come above them, because inflation is going to be with us for a while. And I think it's very, very important to get out in front of that. Given this is the era of private equity and resi and commercial services, we of course get a ton of private equity questions. And as I was talking about on the market update, here in Q4, almost every transaction we're doing except for one is with a private equity firm. And when you think about private equity deals, you largely have two broad classifications. One is a growth equity investment where you're maybe selling 25% of the equity of your business to take maybe a few chips off the table and put cash on the balance sheet and grow it. And the other private equity transaction would be more or less a change of control, where you might sell 80 or 85% of your business, retain 15%, and have a financial sponsor or private equity firm come in and own the majority of it. Those sorts of transactions are typically available for companies that would be platforms, right? So 15, 20 million and above, where you say, hey, valuations are high. I want to take chips off the table. I'm not ready to hang up the boots. I want to continue to run this thing. I want to continue to get a paycheck, and I want to have a portion of my capital in that investment. I want to partner with a sophisticated financial sponsor and sell this 5 or 6 years from now. The industry right now, when I look at pest and HVAC in particular, the extreme majority of the private equity deals are changes of control, whereby people are selling the majority stake in their business and private equity firms are using them as platforms. And then subsequently, the private equity firms will do add-on acquisitions. And in a lot of ways, for those in the pest control industry, you can think about Anticimex, right? So EQT bought a position in Anticimex some years ago. EQT is a large asset management firm. They've used Anticimex, based out of Sweden, as the platform, and that platform has gone on and done a variety of different acquisitions. They've done these bolt-ons or platform acquisitions in North America, and then those platform acquisitions have subsequently done their own add-on acquisitions. So that is the private equity playbook. In a decreasing yield environment, these roll-ups can be phenomenally great investments. In a rising yield environment where we're in right now, things can tend to get more complicated quickly as you're paying higher valuations now. Valuations roll over, interest rates go up. You could have a very long period of doing a lot of very small deals in order to just tread water. I would say one of the things that folks that are not used to dealing with private equity run into is that private equity firms are very different than strategic acquirers. What I mean by that is they don't understand pest control, for example. They have to go out and hire operating partners. They have to learn the industry. So the due diligence process tends to be excruciating compared to dealing with an Orkin or a Terminix or a Rentokil or an Anticimex. Furthermore, private equity firms don't really have a reputation to protect. Rentokil can't afford to go out there, lock up a deal with you, beat the crap out of you, retrade in diligence, and have the whole thing blow up and walk away. I mean, that's not to say strategics don't do this, but you can't make a habit of it, because you get a real bad reputation very quickly and then no one wants to do a deal with you. When you're a private equity firm and you're looking at pest control, you can lock a few things up under diligence, you can push the sellers around, squeeze them out. The deal gets done, it doesn't get done, but at the end of the day, it's not a big deal because you can move on to another industry. I always advise everyone that looks into private equity is that you should run a process. You should run a formal sell-side process whereby you have a plan A, a plan B, a plan C. So if you get into a situation with a private equity firm, who's playing fast and loose in DD, it becomes very easy for you to step aside and move on to the next buyer. I think this is now more important than it ever has been, because when I think about what's going to happen in 2023 with the recessionary environment, with the cost of debt capital increasing, with asset prices rolling over, I think there'll be a lot of retrading in DD. So I think it's really important for everyone out there to keep that in mind. I always say don't deal with one buyer, right? You're dealing with one buyer is like dealing with none. At the end of the day, you always want to be in a competitive situation. And with Dylan out here this week, we are going to record a session that I think I'm most excited about. Everything we've done down here is where I'm going to really get into the philosophy and the strategy behind a proper sell-side process. So we'll do that, and you guys should be seeing that here in the next couple of weeks. I know this was a quick session. I know this was a few questions that have come through. I think I'm going to close this breakdown out with the question that I get most often, which is, where do I think valuations are going? And I think I've laid that out extensively, not only on the Buzz, but with some of the presentations that we've done. If you go back on POTOMAC TV, you'll see Supernova. That was peak pest control M&A in the era of monetary madness. And we did that, I want to say, in June of 2021. We had just done Aftermath a few months before that, where I laid out my theme for 2021, which was scarcity among assets in a dramatic, explosive growth in valuations, which is exactly what we saw. We talked about the fact that the M&A boom in the industry was in late stages. Fast forward to May of 2022 with bubble trouble, we talked about how valuations were rolling over, and now we were in an era of declining valuations, and we have seen that consistently. From May to June to July to August, it continues every month. We lose a few basis points in valuation. So where do I see valuations going? Unfortunately for me and a lot of sellers of assets, I see them going down. Thanks for joining me on this breakdown. Look forward to seeing you again here in San Juan. Take care.